next up we have Alex Rose from Zoopla, or Houseful. I'm sure Alex will explain the new brand. So Alex is right at the back there. So Alex, if you want to take centre stage, over to you.
Morning everyone, standing remotely today, which is amazing to see. Hopefully the technology works for you. So, morning everyone. Just to, I guess, follow really on from what Craig said this morning. I see my job here is to sort of take us through, what our business is seeing at a macro level in the housing market. So we'll talk a bit about the rental market, resale properties. Then we'll go a bit into new build, and then I'll do my best at the end to paint a balanced, positive picture about what we see coming and where the opportunities are particularly for the house building industry. Just to explain, you'll notice perhaps the different branding for those of you who've seen me speak before. So very quickly, we've rebranded what was, I guess, previously the sort of Zoopla corporate B2B website into, really to reflect the range of businesses that we own and operate, businesses that you'll be familiar with that power estate agency businesses with CRMs. Our Yorkeys platform powers about 1 in 10 new homes transactions, and our HomeTrack data business underpins a lot of broker and mortgage decisioning. So I think it's important to take a step back and realise, the breadth of data that we're looking at analysing and that I'll present to you today, and just to explain a little bit about the purple and not purple, the yellow and blue branding this afternoon. So let's get into it really. So a few headlines really on what we see happening in the market. Andrew touched on many of these measures in his presentation earlier. Clearly the sort of mortgage stress testing that's been in place now for a number of years has really helped to, I guess, prevent any issues in terms of people being able to afford their mortgages. The stress testing that's been in place has meant that even people coming out of a fixed rate mortgage and having to begrudgingly pay more in interest have still been able to ultimately afford to pay that and to stay in their property. So we haven't seen many forced sellers that we may have seen historically. Households do have less buying power, and we'll touch on that briefly in a second, but clearly affordability has been really pushed in recent years. We've seen lender forbearance, which has meant, again, we're not really seeing repossessions come to the market, and again, more forced sales. So that's really mitigated house price falls over the last year. One thing that we've seen actually, which is slightly at odds with some of the data that Andrew presented, but we've seen home buyers not really changing their expectations and of what they want. They're not really willing to compromise, and if anything, that's created a bit of inertia where people are saying, no, we're going to stay put, we're going to wait for the right home, the right product, and I think that's probably symptomatic of us being in a kind of a needs-based market rather than a wants-based in terms of buyer motivation. So, a lot of the transactions that we're seeing today are rather, predominantly needs-based, people needing to take on a bigger home for space in their family, and the three kind of death, marriage and divorce as well. So all in all, that creates a hit on transaction volume for the year. And, we pretty much see the outlook over the next few years being, fairly similar. We need to see a bit of a rebalancing in affordability for the market to start moving again in terms of volume. And obviously that's going to take a little bit of time to play out, as Andrew's already indicated. So I touched on an impact to, I guess, buying power. So as interest rates have increased over the last year in particular, essentially going from a 2% rate to a sort of 4 to 5% rate, which is where we find ourselves today, has impacted buying power by about 20 to 28% in terms of absolute values that people can pay for a property. And clearly that's been really the pinch point in the market that's slowed demand. We've probably all seen these charts presented particularly by myself in the past, but this is looking at the kind of trends of demand over the last few years, we saw those huge peaks during the kind of pandemic where there was a bunch of latent demand once the housing market reopened in sort of May, June time of that year. And, you know, as we saw, personal savings grew to, you know, kind of record highs as well. So again, that drove a bit of a demand bubble, if you like, and a pricing bubble where we saw, you know, almost double-digit inflation in some areas. You know, clearly, you know, we all kind of like to point and blame the mini budget, but we can kind of see that before that we saw interest rates were increasing anyway, and we saw demand was slowing. We knew that Help to Buy was sort of coming to an end anyway at the back end of last year. So we'd already seen the market sort of start to cool in terms of demand, and I guess the Kwasi Kwarteng speech was the kind of the icing on the cake for many. And so what we've seen there is a market probably more comparable to kind of 2018, 2019 demand levels, rather than the sort of red hot market that we'd found ourselves operating in the last couple of years. This is a really interesting graph that if you follow our kind of monthly cities index that we produce, our house price inflation report, something that we published last month. But it really looks at the relationship here between affordability in black and interest rates in purple. And you can sort of see the yin and yang impact of, you know, when interest rates move, that clearly has a knock-on impact on affordability as well. I guess what this is most telling of is that black line, and you can see really, you know, since the late 90s, you know, where obviously we had a recession then. We then, you know, as we moved into that kind of global financial crisis and then that record low interest rates, what we've seen is just the incomes to earnings ratio just creep up and up and up and up over time. And so when we then have had a shock to affordability, a further shock, that's been the thing that really has sort of put some brakes on the market in certain areas. And we've already seen now as interest rates have started to fall back a little bit, actually that's started to impact affordability as well. So a really interesting correlation that we see there. And if we look at house prices to income kind of ratios across all parts of the UK, you can see really the correlation where, you know, affordability has become really constrained in many markets, particularly now we've seen in London and the South East, where, you know, clearly the income required as a multiple has been pushing, you know, 10 to 12 times income in many areas. In certain areas of London, you can be pushing 40 to 50 times the average income. Some kind of positive news here, and again, Andrew touched on it in terms of real wage inflation, but you know, what we've started to see now in the kind of Institute of Fiscal Studies data is actually some wage inflation growth and actually outpacing kind of consumer inflation, which is positive news. You know, it's movements like this that will help to address the affordability challenge, but clearly it's going to take a long time to wash through, really, in terms of, you know, most people would probably want a couple of years of real wage growth against affordability to really start feeling like they had more kind of cash in their pocket to put towards property. So, you know, obviously the other metric that we keep a close eye on is house prices. Both impact affordability. When we look at sales volumes, you know, our kind of forecast at the start of the year was around 1 million. We were probably being a little bit, when I spoke at this event in May, I was probably looking a bit more optimistic for next year at that point. And as Craig mentioned in his opening speech, pretty quickly within a month or so, we started to see, you know, inflation much higher than had been forecast, and that had a further impact on interest rates. So we see the market taking a little bit longer to sort of recover in terms of volume. So our current forecast remains around 1 million transactions for next year, of which, you know, we're seeing broadly a sort of 10 to 11% kind of new homes market share at the moment, which is significantly lower than it has been, and we've seen a number of builders kind of revise down output, revise down forecasts as a result. I talked a little bit a couple of slides ago about motivations to move, and we really are seeing the drivers of these moves being, you know, kind of
increased costs to run homes. So obviously we've had an energy crisis in terms of costs and cost of living over the last couple of years. So there's definitely a motivation from certain groups to move out of less energy efficient properties into properties that are more affordable. And I think in May, again, I encouraged any house builder in the room to be shouting from the rooftops about, all the good reasons to buy a new build, and we're continuing to support that message. Clearly, with fewer people in the working market, more people choosing to retire kind of during the pandemic, take either an early retirement, a lot of people are then therefore looking to perhaps downsize and unlock a bit of cash from their property. But reading, again, more articles this morning, it's sort of easier said than done for people to kind of unlock the next move. And so, we find ourselves often in quite an illiquid market. What we are seeing is obviously a shortfall in supply in the PRS market, and rapidly rising rents, which I'll touch on in a little bit. But there is a motivation there. And, our data suggests that about 20% of people in the private rented market could afford a new build property. The key is, do they want to? Is the timing right? There's a number of factors at play there. But again, many house builders either looking at alternative tenures, working with private businesses that can help fund new tenures, or just encouraging people out of the PRS market and into home ownership. We've also seen a kind of twofold impact of more properties coming to the market, but also properties staying on the market longer, or possibly falling through transactions and therefore reappearing on the market. So, the volume of stock available to purchase is 26% above the 5-year average currently, and you can see it's basically back to where it was in 2019. In the years prior to this, we had a lack of supply in the market, which is again one of those factors that's fueled house price inflation and that kind of race for space and demand. So we've definitely seen that it is, the balance has tipped really back to more of a buyer's market, where you would have described it as a seller's market, less than probably 18 months to 24 months ago. And so what we're seeing, particularly across the resale market, is that sellers are being sort of forced, if they're motivated, really motivated to sell, they're being forced to kind of accept a discount to their asking price. Now, there's probably two factors at play here. One is a lot of asking prices we found have been perhaps over-egged in recent years, particularly if someone's using a comparable from 2021. My neighbours sold their property on my street for this price, so I expect to be able to get the same. My kitchen's nicer, all that sort of thing that we typically hear. Estate agents are having to kind of manage seller expectation that if people really do want to move, they've got to be realistic about a bit of negotiation. So we can see during that period over the last few years, very little negotiation on pricing, none for a prolonged period of time. Typically, we're coming in at about 5% discount to asking now. These are for sales that are actually being achieved in the market. So this is a broad picture across the entire UK for sale market. And we'll talk a lot probably about house prices, and I've talked about the fact that wages are starting to go up. That's a positive news. Clearly, to really impact affordability and to do it quickly, we would probably need to see some house price falls, which aren't really happening. Certainly not the way the press would have expected, and forecast, if you like, in their sort of doomsday scenarios in Q4 of last year. We read a lot of publications talking about 10, maybe even 15% house price falls this year. We're seeing about 2% down over the course of the year. And what this chart shows really is, this is all the postcode areas of the United Kingdom. Each of those dots represents a postcode area. And what we can see here is in the lowest price markets, such as Halifax and Motherwell, so the HX and MW postcodes, they're actually seeing some relative house price inflation at the moment, 3 to 4% in those lower value markets. Interestingly, though, as you go further to the right on this, where you've got more expensive markets in central London, there isn't necessarily a pattern to say, well, actually the most expensive markets are seeing the biggest falls. You can see there that there's very little correlation once you get to London in the southeast, and pretty much all those areas are kind of 1 to 2% falls in the year. So again, no forced sellers, mortgage stress testing. What it's created is more of a pattern of inertia rather than a pattern of kind of heavy discounting, additional supply coming back into the market and kind of, bargains to be had, I guess, if you're a buyer. Most areas, about 80% of markets sort of fall into that 2 to 3%. And we're kind of, our crystal ball for next year really is forecasting much of the same in terms of those reductions. So again, nothing there that's going to make the market really move quickly, but also means that the market's not going to, we don't see downside risk for next year at this stage. I'd mentioned earlier that buyers are unwilling to compromise, and this is the data that we see in terms of Zoopla search data. So, if we take a look at, kind of Q3 of 22 versus Q3 of 23, a year on, it's actually a pretty dull graph, if I'm honest. I always debate whether I show it, but there's not a lot of movement. But the point I'm making really here is that, what we're seeing is people are still searching for the same product they are 12 months on. So despite the affordability issues, despite the interest rate rises, people aren't really saying, well, I tell you what, I'm going to settle or compromise for a slightly smaller property. If anything, what we're seeing is people looking at perhaps moving further afield to find value rather than downsizing or taking a smaller property. So really interesting kind of slide. Again, this sort of backs up, tells it in a slightly different way to the slide that Andrew presented, but clearly what we're seeing is those that are reliant on a mortgage and finance to purchase their property. We've seen a reduction year on year in those purchases. Cash buyers have increased. When we talk about cash buyers, I think most people assume that there's kind of investors with deep pockets running around picking up a bunch of kind of HMO bargains and stuff like that. Actually, we're also talking about people that own outright and therefore are looking at downsizing and unlocking some money, as I say, perhaps taking the option to take some early retirement or just shore up their kind of defensive position, if you like, and maybe even help out children to get on the ladder and help them towards a deposit. But we've clearly seen, some impact on the first-time buyer market, and I think, particularly for the audience in this room today, our data and I know Halifax track this quite closely as well, show that about 50% of new builds over the last decade have been sold to first-time buyers. So we don't take this lightly. When we see a reduction in first-time buyer demand here, actually it probably impacts people in this room more than it impacts, the broader housing industry. And this is a way I've kind of represented it using some Zoopla data. Apologies, the font size there is quite small, but what we've looked here is sort of plotted the 6 largest house builders by volume. And the higher up you are on this chart, the higher the average asking prices on the units. And the further to the right is the higher the demand. And so what we saw at the top graph there, going back into summer of 2022, is actually house builders building at a lower average asking price were getting a much higher share of demand, if you like. So, what this indicates really is that because they were outperforming the market with a number of first-time buyers looking to get into those properties, buyer ratio about 3 to 1 as well. So huge demand there for every property, three inquiries a month there. What we've seen is 12 months on is actually everyone's kind of bunched together. So demand is much more uniform, whether you're building a 4 or 5 bed, £500,000 house, or a starter home, a 2-bed at, 180, £200,000 in the north of England. We're seeing that they're much more closely aligned. So really, the impact of those higher interest rates and the ending of Help to Buy has just meant it's much more uniform in performance. Another way of looking at this, and I started playing around with data on Friday night because I'm just that kind of guy, and I was surprised really. I wasn't necessarily expecting this, but what I plotted was just looking at demand for resale properties versus demand for new homes on Zoopla over the last couple of years, and the relationship. So these are not absolute numbers. This is a relationship on for every one of these homes advertised with us, what's the level of demand that it's achieving. And what you can see here is last year in 22, they really just, the two lines tracked each other, whether you're advertising a second-hand property or a new build. In fact, arguably, as we went towards the end of last year and towards the end of Help to Buy, the new build industry was outperforming second-hand properties as more people wanted to move into new. What we've seen, obviously, with this is not only the end of the Help to Buy scheme, but also the impact of affordability on interest rates. And I'd throw in a third thing, which is the relative premium of a new build versus a similar sized resale property, is that we've seen that there's been that rebound that you would expect in the first quarter and the first half in the resale market, but the new build market hasn't experienced it in the same way this year. So certainly more challenging as an operator in the new build industry. And I've seen the new build premium quoted as high as 46% on according to Land Reg data. So it's an interesting one, and I guess it sort of leads me onto my next graph, which is, looking at the top 6 or 7 builders on Zoopla this year, really, and actually over 18 months, you can see that the asking prices have stayed very flat across all house builders. And I'm sure, any house builder in the room, and there are many, would say, viability, cost of build, cost of labour, cost of materials means that, they can't really be in a position to reduce prices, but it just creates that more challenging market where sellers in the resale market who, let's face it, the average seller during the pandemic made about £42,000 in house price inflation over a 2-year period. They're probably having to give away 15 to 20,000 of that to make a sale right now, which it's all kind of wooden dollars really for them, because it means that the next property they buy, it doesn't impact them. So sellers can afford, sellers in the private market can afford to take a bit of a haircut, whereas house builders, generally have a bit of a dilemma here. And so we've seen, obviously levels of incentivization go in, but it's clear that house builders have got to stand out and present their offering and present those incentives in a really clear way when it comes to marketing, because they will be very much compared on absolute terms with the resale market. We talked a little bit, just quick time check. We talked a little bit about, energy efficiency and savings that can be achieved. And, this is data from a survey that we produce every quarter really. And it's shown that, when it comes to a new home, that, if you add the two together in purple there, nearly 70% of survey respondents really value the green credentials as either extremely important or very important in terms of their next property consideration. So, it just goes to show that we can see the trend. It's perhaps not moving as quickly as we'd like, but consumers, are, whether they like it or not, almost being bought into the kind of 21st century. And so this will only become more and more important. And so we see this as an advantage for the industry, and really, really important to begin to capitalise on this, particularly as we look at outgoings and affordability. The cost of owning a new home is clearly much cheaper in terms of the monthly payments that are required. And I promised a bit of sort of positive news. Again, we do this survey. This is our latest data from August, and the next set of data will be out very soon. But we have significant sample sizes here. We have about 2 million people registered with us for a service called My Home, where we communicate with them monthly. And actually 16% of survey respondents in our most recent survey flagged that they want to move in the next 2 years. Big difference between want and will move, but I think positive news there that there are people that are perhaps waiting for the right time, whether it sort of actually comes or not, I think, a few people probably felt that interest rates would fall, quicker than most forecasters would believe. But some really encouraging data in there about buyer intent. So people want to move. Our challenge is obviously making sure that we can enable that. And I touched very briefly, and I'll just touch again on the private rented sector. I mean, you can see here essentially what we're seeing on the left-hand side here is that the number of homes available to rent is pretty much at an all-time low, really. So, there's a real constrained supply in the rental market, and then you can see there the trend in demand where, the average rental property, just 6 months ago was getting about 30 inquiries for every rental property. So there's, in my mind, if you've got 30 inquiries for every rental property, that's 29 disappointed punters. And as I say, 20% of those, according to our analysis, could actually afford potentially to purchase a new build home. So, interesting dilemma there for the room about how we could try and tap into that market and unlock those disappointed people that clearly want to move, want to get into property in some way, and fundamentally need a roof over their heads. And also I mentioned a little bit about people chasing value, and this is some data we see, particularly relevant to the new build industry. So this is the percentage of people looking to move further than 10 miles from where they live today. And so we can see some patterns here in, Eastern England, the southeast, into Scotland, and London as well, that people that live in those areas are looking to move further than 10 miles, sometimes as many as, as much as sort of 50 miles on average. So some people motivated to perhaps look at affordable markets, to chase value potentially, or still relocating, given that we can work from home potentially a little bit more than we could a few years ago. So big pattern there, and I think that's, again, another challenge for any marketeers in this room is, how do you spend your budget wisely, yet reach the people that, perhaps are looking from further out of your catchment zone, and so a real challenge there. And, clearly those people looking to move in the next 2 years, biggest cohort really in that 25 to 44 age range. So almost perfectly on time. I'll just wrap up really. I mean, we'll talk about it a lot today. Those macro challenges remain. They're not going anywhere quickly. But I think for house builders, the key here is how do you optimize pricing, mix, tenure. We're seeing demand here where, 44% of demand in new build comes from further than 10 miles away. Clearly, the value of green credentials is important and set to grow. And in terms of our outlook, we look at, a similar market in terms of transaction volumes next year. As I say, a little bit of price softening, but 16% of the population motivated to move within the next 2 years, and buyers. Many buyers waiting for the right product, which hopefully is kind of music to the ears of anyone in this industry. That the product mix hasn't changed, because I appreciate viability and planning mean that you can't change your product mix quickly. We've just got to find the right way to get people into those properties. And that's me. Thank you very much. Yeah.